Hey everybody, Larry Berman here. Another very, very interesting week from a chart perspective. Let's dive right into the chart. So in recent weeks, we talked about the resistance up in the 4100 area, and all we'll know in February, early February, we kick through that. We closed this week back below those extremes, and while the candlestick on a daily basis was positive, meaning we probed some support around the 40-50 level and closed at the highs of the day, leaving what's called a bullish candlestick pattern there, call it a hammer. You need to see the conclusion and follow through to confirm that that's an important low. So long holiday weekend, we should have seen some selling into the weekend. We didn't. So, from that perspective, kind of some positives, but clearly the negatives when you look at the big picture here and how January went out and basically we're flat through February at this point. All we'll know, a few weeks ago, again, we had the golden cross to the bull side where the 50-day average turned up through the 200. But the key thing here is the 200-day average is actually still falling. Now, it flattened out quite a bit this week. The more time we spend above it, of course, the flatter it'll get. When we look at our fair value metrics based on earnings expectations, risk premium, we get a fair value between 36 and 3,800, approximately range-wise. We did see one of the big Wall Street shops on Friday come out with a March target around 3,850. So it would imply a move back below the 200-day average, and more of markets pricing in a bit of a recessionary scenario. So when we think about interest rates and recession, what's kind of happened in the last few weeks? So this is the SOFR rate for September 2023. And SOFR is replacing LIBOR as the overnight financing rate for the interbank marketplace. That was expecting a terminal peak rate overnight of below 5%. So 95 would mean it's 5%, 95.50 would mean 4.5%. And so now we're trading where that terminal rate by September at this point looks to be around 5.25. So the front end of the curve has kind of listened to the Fed rhetoric. The FOMC, the Federal Open Mouth Committee, was at it big time this past week, trying to walk back the more dovish interpretation that the marketplace took from Powell when he used the word disinflation several times in recent communications with the market. So that's good. And then finally, of course, as we just looked, equities are starting to behave. And so while the terminal rate got priced higher, when we look at the September 23 contract and compare it to the December, Z is the futures ticker for December 2024 contract, we still have 166 basis points of easing priced into the curve from the peak rate now expected in September of 23 through the end of 2024. And in the higher for longer scenario, I think a lot of this needs to get priced out. Almost certainly in a recession, the Fed will be easier on rates, but their higher for message longer is really going to take quite a while here for that to get into the labor market, maybe another 6 to 12 months or so. So what the market celebrated in January as a soft landing scenario or a no landing scenario is now being thought of a little bit differently. And so We do think there's going to be a harder landing. We do think there's going to be a recession. The timing of it, we may already be in it by the time the guys get together and price when that recession began. Because remember, in early 2022, we did see 2 quarters of negative growth, and year on year in 22, very, very sluggish economic growth, even though there's been an uptick in the past couple of months. There hasn't been, from an industrial production and capacity utilization numbers, and we got an update on that this week, and we saw another downtick there with PMIs globally, now coming back below that median level that is suggesting far more economic weakness to come. So really quite a dynamic here at play. And so when we look at quality of the rally and we get into our bull and bear pick of the week, let's have a look at the Goldman Sachs most shorted basket of stocks. So this takes the Russell 3000. This takes a market cap of $1 billion or more, so meaningfully sized companies, not teeny tiny ones. And then what percentage of the short interest is out there. And so when you look at what's led the rally compared to the total US market, to the Vanguard total stock market ETFs like the Russell 3000, pretty much large and mid cap stocks, it's the junkiest, most shorted stocks. And so the conclusion here with very little argument that I can see is that it's really been a junkie-led rally by the crappiest, most shorted stocks. And we can now see that mean reversion coming. So, when the market becomes a buy is when these stocks get terribly oversold and the baby gets thrown out with the bathwater, meaning, the Apples of the world are trading at really fair value. And to me, multiples are still pretty high on some of these names, especially after the recent rally. A lot of good quality companies did rally, but the memes are back. Now, while I'm a huge bull on artificial intelligence, if you look at, again, some of the quality of the companies, this AI, C3.ai company could be the next Microsoft, could very well be the future of enterprise software. They're not likely going to have any positive free cash flow for a number of years still. And so what's led the rally? A lot of these names. And so while, that's okay, I think you look to buy dips here, you don't chase the rallies. So what we're bearish on, the meme of AI, we think there's going to be a significant correction there. Longer term, I love it. Don't get me wrong there. And where do you go for quality these days? DUHP is the Dimensional Fund Advisors high profitability factor ETF. And this is something that we overweighted through most of 2022. It's had a fine rally. I think it's not going to get necessarily absolute gains from here if overall market comes down, but it's going to perform relatively better. So if you want to be there, this is a good place to be. These are high profitability companies, not the whatever next generation of companies that may very well be great one day will not be great if we get into another risk-off environment, which I see coming. Anyways, have a great week, everybody. And looking forward to the new launch of Berman's Call on February 27th at 4:30 in the afternoon from its 11 o'clock traditionary time over the years. Looking forward to that. Have a great week, everyone.